Imagine waking up one morning and finding out that the price of water, yeah, the stuff that comes out of your tap, is being traded on Wall Street. Just like oil, just like gold. Well, this isn't some dystopian movie plot. It's happening right now. And it's not a what if, it's been a reality since late 2020. Investors can actually buy and sell contracts that bet on the future price of water, specifically in drought-stricken California. You see, in a world that's getting hotter and more crowded, water's become incredibly scarce. And you know what happens when something gets scarce, right? Money follows.
So this brings up a huge, fundamental question. What happens when our most vital resource, something we all need to survive, gets turned into just another financial asset?
Okay, so before we can even get into the big ethical debate, we really need to get our heads around how this market actually works, because it's definitely not as simple as just buying a bottle of Evian.
Here's the deal. These things called water futures trade on the Chicago Mercantile Exchange, and their price is tied to a real-world benchmark called the NASDAQ Valles California Water Index. Its ticker is NQH02. Basically, this index just tracks the average price of actual water rights being bought and sold in California's major water markets.
Now, they don't trade it by the gallon. The unit they use is something called an acre-foot. It's a standard term in water management, but let's be real. What on earth is an acre-foot?
An acre-foot is a lot of water. We're talking about 326,000 gallons. To put that in perspective, that's enough water for about 3 typical households for an entire year. And each one of these futures contracts represents 10 of them.
But here is the absolute key detail you have to understand. Nobody is loading up tanker trucks with water when these contracts expire. It's all settled financially. It's what's called cash settled. So it works less like you're buying a barrel of oil and more like you're taking out an insurance policy against the price changing. You just pay or receive the difference in cash.
So who is actually using this new market, and is it, even working the way it was designed to? This is where we start to see that classic gap between the theory and the on-the-ground reality. All right, you've basically got two types of players here. On one side, you have the hedgers. Think farmers, city water departments, big companies. They're the ones who actually use water, and they just want to lock in a stable price to protect themselves from risk. And on the other side, you've got the speculators. These are your investors, your hedge funds. They're not using the water. They're just betting on which way the price is going to go.
But here's the catch. So far, the market's been pretty quiet. There isn't a lot of trading volume, which traders call being illiquid. It's kind of like trying to sell a super rare comic book. If there aren't many buyers, it's hard to get a fair price. This quote from a California farmer, the exact person this market was supposed to help, says it all. It's tough for a big farm to make a move without causing a big splash that moves the price against them. And whoa, just look at this chart. It shows you how incredibly volatile this market is. Back in late 2022, during a really bad drought, the price for an acre-foot shot up past $1,200. But then, just a few months later, California got hit with a ton of rain and the price crashed all the way down below $200. I mean, those are the kinds of wild swings that make this market so interesting to both the farmers who need protection and the speculators looking to make a profit.
So all of this volatility, all this speculation, it all leads us to the central controversy. And this isn't just about dollars and cents, it's a deeply ethical debate.
Yeah, you can bet that as soon as this market went live, the criticism came pouring in. This statement from a UN special rapporteur really gets to the heart of the fear, that treating the one thing we all need to live like it's just another commodity is a really dangerous road to go down. And the critics point to some really serious risks. I mean, could speculators corner this small market and artificially drive up prices? Could it create a weird incentive to hoard water rights, making actual water shortages even worse? And what about the small farmers who can't afford to play in these markets? Or the environment itself, which doesn't get a say at all? These are huge questions.
But of course, there's another side to this story. The people who support the market say, hey, this brings price transparency to a system that was totally opaque before. Their argument is that when everyone can see the true cost of water, it creates a really powerful reason to conserve it and to make sure it gets to where it's needed most. It could actually drive efficiency when every single drop counts.
So where does all this leave us? Is this whole thing just a weird California experiment? Or are we looking at the blueprint for a future where water is traded all over the world, from Australia to the Middle East as shortages get worse? The stakes here are incredibly high, and it feels like we could go down one of two very different paths. The best-case scenario, these market signals push us to conserve more,
allocate water smarter, and invest in resilient infrastructure. But the worst case? Financialization makes water unaffordable for millions, widens the gap between rich and poor, and turns our most essential resource into another poker chip for Wall Street.
No matter what happens, one thing is clear. We can no longer just assume that water will be abundant and cheap. For the first time ever, its price is right there on a screen for the whole world to see. Which leaves us with a really critical question to think about. Should our most essential resource really be just another ticker symbol?